All right. So, hi everyone. This is Kevin Matthew, and welcome to my first AFM debrief. I'm a recently qualified ACCA affiliate, and you will find many more such videos on this space. It will primarily relate to AFM, the professional level paper in ACCA. So, guys, hope everyone is doing well, and thanks for joining. However, without further ado, let's move straight into what our business is. We'll be discussing a topic called NPV. Now, guys, this is a topic which is significantly tested at both your FM and AFM level. At FM level, it's typically a section C question worth 20 marks, which will include both numericals and discursive bits. Whereas for AFM, it's very exam specific. I cannot really pinpoint and say as to which section of your exam would contain this. It could be a section A question or even a section B question, but you can be rest assured that you will have some amount of NPV in your exam. Uh, it could as well be a variant of NPV. It could be an APV, it could be a foreign appraisal, it may as well be a BSOP. Guys, I understand that these terms at this point may be a little unfamiliar to you. However, as we progress, you will get more and more familiar with all these. So more of this at a later stage. All right. Now, guys, just to start off, NPV, I'm sure NPV is a concept which most of you, if not all, are familiar about. We all have covered NPV at some point or the other, either during our university days or, if you're an ACCA candidate who has attempted fundamental papers, I'm sure you should be aware of what NPV is. So, guys, assuming that you all are aware, I'm not going much into the detailing of NPV. I would prefer focusing on more important topics, especially for a paper like AFM. However, there is a bit of information I would want to give you on NPV as well. Primarily deals with what are the items, what costs would you include in an NPV computation. There's something called as relevant costs, guys. I'm sure you've done this. Uh, if I'm not wrong, the first time you would have attempted this in F5. So anyway, let's have a look at what relevant costs is. Okay, I hope this is legible. Anyway, guys, relevant costs have three branches that you're supposed to be aware of. The first one is incremental. Sorry, yeah. Second is opportunity costs. I'll tell you what all this is. And the third one is future costs. So guys, what do we mean by incremental costs? Now, please make sure that these are the costs which, or rather I would say better than costs, you can use the word cash flows, relevant CFs, relevant cash flows. So please make sure that whenever you get an NPV question, you only include cash flows which meet this criteria, especially the first one, incremental. Now, what is incremental? Uh, any cash flow that arises as a result of a decision made is incremental. Let me give you an example. Now, a simple example would be you have decided to invest in a project or in a business somewhere. Now, when you're investing in a business, you definitely require some amount of marketing, don't you? Of course, we require. Now, because we are undertaking marketing, we will as well incur certain expenditure. So that expenditure incurred is an incremental expenditure. Why? Because this is being incurred as a result of that decision made. What is the decision? To invest. Now think about it. If you hadn't decided to come up with that project or business, would you need marketing? Of course you wouldn't. At the same time, if there is no marketing, would there be any marketing expenditure? Definitely not. So what does it indicate? In such a case, it has to be an incremental expenditure. So just to repeat, any expenditure, any cash flow that's incurred as a result of a decision made is incremental expenditure. That's one. The second, opportunity cost. Now I'm quite sure you will be and you should be familiar with this terminology. I'll be very surprised if you aren't. Opportunity cost. Probably if you're from the CBSE background or the state level background, this topic should have been covered in high school, opportunity cost, or even in most of the earlier papers as well, we have discussed. Just to sum it up, opportunity cost is the next best alternative that is foregone. Just to repeat, the next best alternative that is foregone is called opportunity cost. Guys, I'm not going much into this because, see, at AFM level, they didn't test all this. This is just a background for us to solve questions as we go. The third feature, it has to be future. You cannot include a cost, any relevant cost that's incurred in the past. It has to be in the future. That's the basic premise of NPV. All right. So guys, you must bear these things in mind. However, there are certain more important things as well. There are certain traps that the examiner can set. I know this may be a negative word. However, I would like to address these as traps just to grab your attention and also so that you will focus a lot more than the others. Guys, the first is there are certain costs that are irrelevant. In the above section, we were talking solely about relevant costs. However, at the same time, you have many costs as well, which are irrelevant. Let's look at a few of them. Dividends. Guys, please ensure any form of dividends, all form of dividends, extremely irrelevant. We don't include it in our computation. If ever you have a question which says a certain amount of dividends was declared, whatever, avoid it, ignore it entirely. We don't include dividends. Next, sunk costs. A very familiar terminology, at least for a few. All right, now guys, this requires a little bit of explanation. Guys, all right, so what is it that's meant by sunk costs? Sunk costs are basically your historical costs, rather the costs that have already been incurred. Costs that are already incurred are called historical costs. Let's give an example from an exam perspective. You know, guys, this has happened previously as well. This can be a huge trap for students. The examiner can trap you. Just kidding, guys. However, please note this. You could have a scenario in the exam where they'll tell you, say, about $10K is incurred for research to determine the project feasibility. Okay, so guys, what is meant by this? $10K is incurred for research. Now, basically, what they're trying to tell you is you have incurred a sum of $10,000 for research. That is to determine if the project is feasible or not. You're conducting a certain amount of research, which will tell you whether you're supposed to go ahead with the project or not. Now think about it. Is this a relevant cost? What do you think? You can pause this video and take a while. Just think. Anyway, the answer to this is that it's irrelevant. It's irrelevant. When I was a student, I as well got a little confused with this. However, the logic behind this or rather the logic behind a relevant cost is that, as I told you, a relevant cost is a cost that's incurred as a result of the decision you make. But guys, just think about it. Here, this 10K is spent for what? Is it as a result of the decision made? No. You're spending 10K to know whether you're supposed to make the decision or not. You're spending 10K to know whether you're supposed to go ahead with that project or not. You haven't decided yet. You still haven't decided that you are supposed to go ahead with the project. You're spending this much conducting research to know whether am I supposed to go ahead with that. So this, your incremental costs will now depend on the outcome of this decision. So to keep it short, this is absolutely, wholly and solely irrelevant. Guys, this may seem a little repetitive, but let me tell you, this can cost you at least 1 mark in the exam. And these are simple marks, which y'all must at any cost not lose. This has happened. We'll be looking at questions as well. The third one, a very, very popular area, is interest. Guys, the examiner can tell you, he can tell you that, the project requires, say, 16K, $16K million, or whatever figure he gives you. And he also tell you that this amount required is financed by a 5% loan. We would have a few candidates who would include the interest every year. But guys, please note, interests are irrelevant. We never, ever, ever include. I'll tell you why that happens, in the following videos. But for time being, please understand, interests are irrelevant, not to be included. If ever you have any information on interests, ignore it entirely. You don't need to include interest. You don't need to include. All right, primarily, okay, I'll just throw a little bit of light on that. Primarily because we focus on discounting here. All these are cash flows which have to be discounted. Your discounting factor, which is the WACC, the weighted average cost of capital, that includes interest, the cost of debt, which is why we've already been using this. So interest here, interest on loan, whatever, ignore it. We don't include that as a cash flow. All right. Okay. So guys, earlier what I had done, the relevant costs, as you can see, this section, from an AFM perspective, the examiner will not emphasize much on these three. However, he generally likes to keep it straightforward. But guys, please be aware, these things, dividends, sunk costs, interest, very, very, very important. All right, please don't fall into that trap set. Okay, so dividends, sunk costs, and interests are absolutely irrelevant. All right. Okay, so that now we have an idea on what are the kind of costs that we're supposed to include. Let's go in to an NPV format and see how that looks like. All right. So if I were to open a new page, okay. All right. So guys, now let's have a look at the NPV format. Okay, just bear with me for a minute. All right. So guys, the most important thing whenever you do an NPV question is to pick the timeline. It's very, very important. Uh, the examiner generally doesn't play around much with the timeline. However, he has done it on a few occasions previously, and that's really confused the students as well. I'll speak more about that as we do a question. So probably by then you will be a lot more familiar. For time being, let's have a look at the format. Okay. So guys, now for your exam, please make sure that you carry a scale, an eraser. This may seem a little funny, as if it may seem as if I'm speaking to school children. But then guys, this format is very important. It has to be neat, very, very neat. So please make sure there is proper spacing. You draw the lines correctly. All that matters. It helps create an impression in the mind, in the minds of all examiners. All right. So please make sure you do that. Fine. So let's start off. T0. T0 is, guys, these, what I'm going to write here is, the number of years. You have to pick that from the question, as I told you, the timeline. Guys, T0 is a time. What does T0 indicate? It means now. There is no discounting that's happening here. It's now, T0. T1 is your first year. T2 is your second year. I'm not writing, I can write T3 here if I want to, but I don't want to. I'm leaving the space for something else. All right. But you can assume it will continue with a T3 to T4, T5, etc. That way. That's very question specific. For simplicity reasons, I've just had a timeline from T0 to T2. Okay, now what are the items that will appear here? To start off with, you will always find sales. On most of the occasions, or rather all occasions, you will have sales. Now this invariably is the only inflow in your NPV computation chart. The next item would be variable costs. Next one, fixed costs. You would have a certain amount of depreciation. Your depreciation will be on the amount of investment you make. Guys, this could be, you could have a straight line method or written down balance method. Refer the question. They'll tell you clearly what you're supposed to do, which method you're supposed to follow, all that. The last but not the least, any incremental expenditure. As I told you, so just to recap, what is it? What is it that's meant by incremental expenditure? Any expenditure that's incurred as a result of the project undertaken or the decision made is called incremental expenditure. We did this just a while ago. Okay, so if I were to put the amounts here, guys, variable cost is an outflow, fixed cost is an outflow, depreciation is an expense, so it's an outflow. So what am I doing here? Now, guys, this is a bit of maths here. So we have to do it for each year. So sales minus variable cost, minus fixed cost, minus depreciation, minus any incremental expenditure will give you something called as operating profit, or your PBIT as you call it. This is what you get. Following an operating profit, this could be an operating loss as well, operating profit or loss. I'm assuming it's a profit. Following an operating profit, you will have tax. Tax at specific percentage, this will be given to you in the exam. Guys, there are two things here. The first thing is, at the F9 level, we required a calculation of capital allowances. Fortunately, that calculation is not required at the AFM level. All you have to do is use the tax percentage given on your operating profit. For example, if your tax percentage is 20%, you will calculate 20% of your operating profit in the first year and write it down here. And same would apply for the subsequent years as well. But one other important thing to be noted is, when are you paying the tax? Are you paying the tax in the same year as it arises, or are you paying it in the following year? Is it a same year tax or a calls in arrears? That means you're paying tax with a delay of 1 year. So guys, if you're paying tax in the same year, you will have, a typical percentage of tax will be applied to your operating profit, and the figures would look like this. However, if it's a tax in arrears, what would you do? Your first year's tax would be payable on your third year. Your second year's tax will be payable. Sorry, guys, your first year's tax will be payable in your second year. Your second year's tax, which is T2, will be payable in your third year. So you're paying tax with a delay of 1 year. Guys, one more thing here. When you pick the timeline, whenever you pick the timeline, be a little careful. As in when you draw. For tax in arrears, you will require an extra column as well. You can mess it up in the exam. Sometimes what we do is we sort of ignore, we forget that we require an extra column for tax and arrears. Now say my timeline tells me that, now what's the timeline I have here? It's T0 to T2. So, but however, if it's a tax and arrears question, I must have an extra timeline as well to accommodate the tax figure. All right, okay. So the next is investment. Guys, your investment is always now. Or rather, if I were to simplify it, investment is always made before the project starts, just before. And on most of the occasions, it's at T0. The next is scrap. Okay, guys, scrap is your selling price of the project. This generally is incurred in the final year of the project, and it's a positive figure. Next is working capital. I'll just extend my lines. Okay. Now, guys, this actually is a little, not complex, but then it can be a little confusing for students. We'll do a detailed working on this as we hit a question. For time being, sorry, guys. I'll tell you what this is a little later. Just bear with me for a while. We'll do a comprehensive question on this, and that's when you will know how to use this. For time being, just understand that you will incur a certain amount of working capital in T0. It will continue all through the project on an incremental basis, and all the working capital expenditure that you've incurred will be released in the last year. So your last year of working capital, or rather your working capital of last year, will be a positive figure. Okay, so once you're done with all this, guys, a very, 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 very important point. Now, I told you a couple of minutes ago that we don't do the calculation for capital allowances, which otherwise is tax depreciation. But guys, we have got to add back the depreciation amount here so that we nullify the effect of this tax computed. It's vital that you remember this point. We have taken the tax figure here. We've also included the depreciation here, but we're just adding back the depreciation here so that the tax effect, the effect of tax is nullified, which invariably means that we are avoiding the calculation on capital allowances. As I just told you, this is a shortcut. At your F9 level, your financial management level, this carried marks. The capital allowances working carried marks as well. So we couldn't afford to do this. However, at AFM, the examiner doesn't bother much about capital allowances. Instead, We can do this. This is a simple and easy way as well. Okay. So once you're done with all this, you get something called as free cash flow. And how do I get my free cash flows? I've got my operating profit here, operating profit minus tax, all these mathematics here. If you do all that, you will end up with free cash flows. Invariably, your investment phase T0, the cash flow has to be negative. Continues. Discounting factor. Guys, the discounting factor on most occasions will be given. However, on a few occasions, you may have to compute that as well, but that's fine. We'll speak more about that as we hit a question. For time being, let's assume that you have a discounting factor. At T0, your discounting factor is always 1 because it's now. Now, it's not in the future, it's now. You would have a discounting factor here. Let's assume 0.909, 0.826, and all blah, blah, blah to follow. Solving this, you get something called as discounted cash flow or present value. You can call it anything you want. Negative. A sum total of all this is NPV. If NPV is positive, we accept the project. If negative, reject. Because this is the basic premise of NPV. This is the reason we are doing all this calculation. If your NPV is positive, you accept the project. If not, reject. Now guys, there is one small thing which I want to tell you as well. There's a very interesting mnemonic to remember. I understand that it may be a little difficult initially to grasp all these. There's a small little mnemonic which will help you and let you know what are you supposed to include here. It's called OTIS, O-T-I-S-W. O for operating profit, which is here. T for tax. I for investment, that's here. S for scrap, and W for working capital. Plus depreciation. So guys, once you remember this mnemonic, OTIS W plus depreciation, you have literally covered all items that can be included in an NPV computation format. All you have to know is how you arrive at operating profit, which again, guys, from an accounting background, every person would know. Sales minus variable costs, minus fixed costs, minus depreciation, minus any other expenditure will give you operating profit. A mnemonic to remember for this, OTIS W, O-T-I-S-W plus depreciation. O for operating profit, T for tax, I for investment, S for scrap, W for working capital, plus the add back of depreciation due to the lack of capital allowances calculation. All right. Now guys, let's have a look at working capital. Now guys, this is a very important calculation from an exam perspective. This generally is a 2 marker. You would find this every time. Very, very rare that you won't find. Guys, there are 3 features you're always supposed to remember. The first is invest at T0. The second would be incremental. And the third is released in the final year. Guys, these terms, I understand that these terms may not be very familiar. It's fine. Just bear with me till we hit a question. I'll show you how exactly these things are applied as we do a question on working capital. But please make sure that once we do a question, you remember these 3 areas. They are very, very important in terms of working capital. This typically is a 2 marker in an NPV computation. But if you understand the logic and remember these 3 points, I don't think you should be finding it difficult to gain those 3 marks. All right, guys. So I feel that's pretty much the computation of NPV. One second, guys. Okay, so just to have a recap of whatever we've done. So as I said, be very, very careful with the timeline of the NPV. Here we've assumed that we have a timeline of T0 to T2. That is your project will last for 2 years. So you will have your sales, you will have your variable cost, your fixed cost, depreciation. Depreciation depends on the method. Depending on the method given the question you're supposed to follow, it could be a straight line method, it could be a reducing balance method, and any other incremental expenditure that's given. And once you do the maths here, that is sales minus variable cost, minus fixed costs, minus depreciation, minus your any other incremental expenditure, as you can see here, you get something called as operating profit. And to your operating profit, you will apply the tax at whatever percentage is given in the question. Your tax can either be in arrears or the same year. If it's the same year, a very straightforward computation. Your percentage of tax for that year will be applied on the operating profit of that year. That's it. You've got these figures. However, if it is in arrears, a small change, the tax for your first year will be paid in the second year. The tax for your second year will be paid in the third year, and so on. It continues that way. What you're supposed to note here is if you have a question with tax in arrears, please make sure that you make an extra column to accommodate for that extra figure. All right. The next is investment. Investment generally at T0 now, or rather you can say before the start of a project. But usually on most of the occasions, it's at T0. That's now. Scrap. Scrap is a positive figure, your sales price. Basically your sales price of the project, not the selling price, the sales value, how much you're expecting to sell your project for once your project is done. That's always in the final year. And it's a positive figure. Working capital, as I just explained, and very important, please don't forget, add back of depreciation to nullify the effect of tax. So the mnemonic to remember this, OT is W plus depreciation, O for operating profit, T for tax, I for investment, S for scrap, W for working capital, plus add back of depreciation. Guys, on certain occasions, you will not require this add back. I don't want to confuse you much with that. I'll come to it later. But then for time being, please remember this mnemonic, OT is W plus depreciation. All right. We then spoke about free cash flows. Once you do the mathematics here, that is the addition and subtraction, you get free cash flow figures. Free cash flows are those cash flows which are ready for discounting. Apply the discounting factor to it, get the present value. Your figure here into your discounting factor will give you the present value of the first year. The free cash flow of second year into your discounting factor of second year will give you the PV of the third year. Oh, sorry. I'll just repeat all over again. Sorry, guys. So what you get is generally at T0, not generally, always at T0, your discounting factor is 1 because it's now. This is the period. Your free cash flow for now at T0 into your discounting factor at T0 will give you the present value of T0. The same here. The free cash flow of the first year into your discounting factor of the first year will give you the present value of the first year. That continues all through. So once you take the sum total of all this, you get the NPV. If it's a positive one, accept it. If it's a negative one, reject. That is how a typical NPV computation looks like. Now, guys, we spoke about something called as working capital, as you can see here. These 3 points are very, very, very important that you must bear. We will do a question, and that's when you'll get to know how these points come across. All right. So, guys, I feel I've covered as much as I can as far as this NPV computation is concerned. And guys, as I told, I've said in my previous blog as well, you have to ensure that you practice questions. For AFM, question practice is the key. Practice as many questions as you can. I will be covering close to 20 to 40 questions across all topics, which I feel should be enough for you when you appear for the exam. All right. So this is it. Because I'm stopping this recording here. My next video would be a comprehensive question on this NPV. And once that question is done, I'm sure most of you will be more or less sorted with this concept of traditional NPV. All right. So guys, until we meet next time, see you.